Foreign central banks are dumping United States Treasuries at a staggering, unprecedented pace. And if you turn on the news today, the financial talking heads are in a complete panic. They are screaming that this is the beginning of the end for the US dollar. They are telling you that foreign nations have somehow magically known about an impending war for months. And they are now aggressively selling off their American assets in a coordinated effort to ditch the dollar as the global reserve currency. But hold on to your hats, because that is not what is happening at all. You see, while everyone is staring at the war headlines and panicking about the fall of the American empire, they are completely missing the actual reason these foreign banks are dumping their treasuries. And more importantly, they are completely missing the massive, hidden force that just stepped in to buy all that debt and save the entire market from collapsing. Today, we are going to look past the fear-mongering and look directly at the actual money flowing through the system. We are going to expose exactly why foreign central banks are selling, who exactly is buying it all up, and why the machines running Wall Street just violently flipped their switches from sell to buy. So, let's start with the big, scary numbers. The New York Fed recently confirmed a massive trend. Foreign monetary authorities, which is just a fancy way of saying foreign central banks, sold off US Treasuries for 5 consecutive weeks. And this selling didn't start when the recent war broke out. It started the week right before the conflict even began. In those 5 weeks alone, foreign central banks dumped over $90 billion worth of US Treasuries onto the market, with the vast majority of that selling crammed into the last 3 weeks. When you see a number like $90 billion being dumped right before a war starts, it is incredibly easy to assume the worst. It is easy to think, aha, they knew the war was coming. They are dumping our debt to punish us and destroy the dollar. But the truth is far less dramatic, and honestly, a little more desperate. It has absolutely nothing to do with destroying the dollar. To understand why they are selling, you have to look at how these countries actually operate when the global economy starts to slow down. Think about energy-producing nations in the Middle East. When global trade slows and demand for things drops, these countries start losing their main source of income, oil revenue. But they still have to run their countries. They still have to fund their own defense spending, buy their own energy, and keep their own economies from collapsing. And what do they need to buy all those things? They need dollars. So, what happens when their oil revenue dries up and they suddenly find themselves scrambling for cash? They reach into their massive national piggy banks. When these countries are making tons of money, they take their surplus cash and buy gold and US Treasuries. Why Treasuries? Because a stack of dollar bills doesn't pay you any interest, but a US Treasury bond does. And more importantly, the Treasury market is incredibly liquid, meaning if you suddenly need a mountain of cash, you can sell those bonds instantly. And that is exactly what happened. The global economy was already slowing down. There was an impact from tariffs, demand was dropping, and a global dollar shortage was squeezing everyone. So, as things got worse leading up to the war, these countries simply cashed in their rainy day funds to get their hands on the dollars they desperately needed. In fact, it wasn't just treasuries they were selling. Countries like Turkey sold or swapped around 58 billion tons of gold, worth roughly $8 billion, since the war started. Why? For the exact same reason. They were turning their assets into cold, hard US dollars. But here is where the story gets really interesting. When you have foreign central banks dumping $90 billion worth of treasuries onto the market, the basic laws of supply and demand tell us that interest rates should skyrocket. And yes, we did see the 10-year Treasury yield shoot up a bit. But it didn't completely explode. Rates didn't go anywhere near some of their recent highs. Why didn't rates go higher? Because for every seller, there has to be a buyer. Someone with incredibly deep pockets stepped in and happily bought up all that debt. And who exactly has pockets that deep? Large US commercial banks. And one bank in particular was leading the charge, Wells Fargo. If you look at the data for Treasury and agency securities held by all commercial banks, you will see a massive spike starting around mid-2023. They have been aggressively loading up on this debt, effectively putting a ceiling on how high yields could go. Every time rates start to creep up, pushing bond prices down, these big banks are eagerly waiting to buy them up. But why are banks so eager to buy up government debt instead of lending that money out to you and me? Because they know the economy is slowing down. In a debt-based economy, you generally want banks to lend money to businesses to drive growth. But right now, the banks don't want to take that risk. They are choosing the absolute safety and security of government bonds over the risk of lending money to regular people during an economic slowdown. The Wells Fargo's involvement goes even deeper than just buying bonds for their own portfolio. Last year, Wells Fargo was finally freed from a US-imposed cap on its assets. Suddenly, they had a massive pile of pent-up cash and they needed a place to put it. So, they pushed more than $200 billion into overnight repurchase agreements, also known as the repo market. The repo market is basically the overnight lending system where huge financial players, like hedge funds, borrow cash to fund their fast-moving strategies. But to borrow that cash, they have to put up collateral. And what is the best, safest collateral you can possibly use? US Treasuries. So, as Wells Fargo flooded the repo market with $200 billion of fresh cash, it created a massive surge in demand for the treasuries needed to back those loans. Hedge funds borrowed the cash, bought the treasuries, and effectively absorbed the $90 billion worth of debt that the foreign central banks were dumping. Wells Fargo essentially stepped in and kept the entire financial system running smoothly. That is the real reason the market didn't completely fall apart. And I know what you are thinking. Okay, so the bank saved the bond market. But what about the stock market? Why did it suddenly start rallying in the middle of a war? If you remember just a few days ago, the market was selling off hard. Everyone assumed it was humans panicking about the conflict. But it wasn't. The sell-off was almost entirely driven by machines. The algorithmic trading programs that run Wall Street were positioned for a downturn, and they aggressively shorted the market. But then, the data changed. And the machines changed their minds. Goldman Sachs explicitly tracks how these massive trading algorithms, known as CTA letters, are positioned. Goldman calculated that if the S&P 500 crossed above a very specific threshold, specifically around the 6,735 to 6,738 level, the machines would be forced to reverse course. And what happened? The market pushed up, crossed that invisible line, and triggered a massive short squeeze. When a machine is shorting the market and the market suddenly rallies, that machine starts losing money incredibly fast. So, to stop the bleeding, the machine has to buy back the stocks it shorted. This forced buying pushes the market even higher, forcing more machines to buy, creating a massive wave of demand. And it wasn't just the trading algorithms. The options market was loaded with people holding put options, betting on the market to go down. As the market rallied, they had to close out those puts, adding even more fuel to the fire. Dealers had to turn around and chase the market upward. But why did the market push up and cross that threshold in the first place? What fundamentally changed? It was the American consumer. Despite all the doom and gloom, consumer confidence actually rose. People are feeling optimistic about the job market. In fact, recent data shows that a larger share of people are planning to buy major appliances, like refrigerators, in the next 6 months. They are looking to go out and spend. Why are they suddenly feeling so flush with cash? Because it is tax refund season. The big question was whether people would save their tax refunds or spend them. The data is clearly showing that they are spending them, and that extra cash is allowing them to temporarily absorb the shock of higher energy prices. And the labor market is backing this up. The recent ADP report showed that U.S. companies added 62,000 jobs, primarily driven by small businesses with fewer than 20 employees. Even more telling, workers who changed jobs saw a 6.6% increase in pay, and those who stay at their jobs saw a 4.5% increase. Wage growth is currently outpacing inflation, giving people the confidence to keep spending. Retail sales increased by 0.6%, fueled by a resurgence in auto sales. This tells us that consumer demand was holding strong right up until the war started. And while the overall, long-term trend still points toward a slowing economy and a potential recession down the road, this sudden injection of tax refund cash and resilient spending is enough to prop the market up in the short term. The market is looking at this data and saying, hey, if the consumer held up this well in February, what happens when all the wealthier Americans who file their taxes late get their massive refunds in mid-April? They are anticipating another wave of buying. So, let's tie all of this together. The foreign central banks sold off treasuries to get desperately needed dollars, not to destroy the US. Wells Fargo and the repo market stepped in to absorb that debt, keeping the bond market stable. The American consumer got their tax refunds and decided to keep spending, which pushed the stock market just high enough to force the trading algorithms to flip from selling to buying. And that is how you get a massive, machine-driven rally right in the middle of a geopolitical crisis. Now, how long this short-term rally lasts is anyone's guess, but for now, the machines are in charge, and they are buying. Keep your eyes on the data, stay rational, and I'll see you in the next one.